Assalamu alaikum. This is Nafiz Ahmed Ifas. Now I am going to talk about what is SRI. SRI means socially responsible investment. An investment that is considered socially responsible because of the nature of the business the company conducts. Common themes for socially responsible investment include avoiding investment in companies that produce or sell addictive substances like alcohol, gambling, and tobacco, and seeking out companies engaged in social justice, environmental sustainability, and alternative energy clean technology efforts. Socially responsible investment can be made in individual companies or through a socially conscious mutual fund or exchange traded fund FTF. Over the past 2 decades, an increasing number of shareholders have begun to consider non-financial criteria such as social and environmental criteria in making investment decisions and executing shareholders' rights. Investing based on such criteria is often labeled socially responsible investment. Corporate governance performance of public companies, various actors with different motives engage in SRI through distinct strategies. Although the effects of SRI strategies are difficult to identify and quantify, overall SRI does not yet play a major role in changing ESG performance. Several factors can be identified that impede SRI in improving ESG performance, together forming an action agenda for SRI researchers and practitioners. The research agenda for SRI studies should include examining poorly studied engagement strategies, identifying the factors that govern SRI effectiveness, including the relationship between shareholders and other actors such as NGOs, governments, and media, and building theoretical frameworks to understand and analyze SRI, for which the theory of stakeholder salience and ecological modernization theory provide promising starting points.
My name is Anika Maisha Hossain, and I'm going to be talking about the similarities and differences between Sharia law banking and socially responsible investments. Let's start with the similarities first. Both SRI and Islamic financial banking prohibits you from investing in bad habits like gambling, alcohol, and distribution and making of weapons, pornography, etc. Both the roots of these systems are from religious doctrines enjoining moral and ethical investment. Both embody the principle of risk sharing as opposed to risk shifting. Both encourage CSR and protection of society's interest. Both aim a better economic system. Ethical fund in SRI and Islamic funds are all the same. Let's move on to the differences now. Differences are that in Sharia law, you cannot take interest from the bank because interest taking in Islam is haram. But in SRI, you can take interest from the bank and you can make investments in the bank, for example, like in Grameen Bank. Islamic finance has to go through the purification process by eliminating any portfolio of income that are related to the interest of any impermissible revenue sources like tobacco, weapon production, distribution, gambling, pornography, etc. Islamic funds look into the matters such as investors' ethics and promotion to the social welfare activities. You should not make money out of money. Instead of interest, lenders charge fees. The bond will eliminate its cost based on its fixed assets, variable cost, cost of employees, rent, etc. The system can make Islamic finances costly. The cost of the system are shared by the borrowers. The fewer the borrowers, the more each has to pay. In many cases, it requires the lenders and borrower to share the profit and loss. Let's talk about Islamic bonds, which are not present in SRI. The Islamic bonds are called sukuk. Bondholders buy share of a business property. If business is good, they could get back more than they expected. But if there is no guaranteed repayment. If it fails, then they will make a loss. Islamic lending practices are also meant to be socially responsible. In world banking, less than 1% is Islamic finance, but it is growing at a rate of 15 to 20%. Found in 2008 that they lack complex products like futures and derivatives. Less should risk. Islamic law does not look into all human rights matters and environmental screens, but SRI does. In SRI, profit making is a fundamental goal, while in Islamic law, it is not the fundamental goal. In SRI, they focus on sustainability, social instances, and governance practices, and also on financial returns, while Islamic practices focus more on Islamic law, Sharia law, and temporal law.
I'm Sabirishi Chaudhry, and I'll be answering the following question. This really depends on to what extent interest rates played a role in the global recession. And according to research and stats, they did play a major role. So first, let's define recession. It is basically a period of economic decline in which trade and industrial activities are reduced. So just a short recap, the Sharia law includes no interest be paid on any financial product. All financial products must be backed by a tangible asset. Product or service being sold should not be linked with alcohol, tobacco, gambling, etc., etc. And 2.5% of one's wealth should be given to charity. So if the Sharia law principles were more enshrined in the financial sector, we wouldn't have had the financial crisis in 2008 because Sharia law encourages debt forgiveness. And let's be real, countries all around the world are in high debt. The high interest rates are not helping either. For example, Sri Lanka is in debt to China due to high interest rates. The financial crisis was a result of over-speculation of financial instruments that had artificial value, and this would never be permitted in a truly Islamic financial system. The capital taxation is only good for 0.1% of the people who have access to back channels, which means corruption. Instead, if the Islamic finance law was followed, it would mean giving away 2.5% of the value of your assets to the poor, and this would bring in a drastic change in the wealth distribution of every economy. As we all know, wealth is not equally distributed. So when an economy flourishes, the rich are getting richer and the poor are getting poorer. So this leads to very low economic activity as the majority of the population are not being able to spend as much or don't have the purchasing power because they are in debt. So theory-wise, in an ideal world, yes, global recession could have been avoided if the banks and financial institutions follow the Sharia law. That being said, a sudden adherence to Sharia law in the financial sector would possibly contribute to recession as well, since many products and services that were previously permissible would become unlawful. Banks which exist to only make profits by charging interests would have closed down, leading to even lesser banks to take loans from, leading to lower economic activity. Moreover, financial transactions within Islamic banking are a culturally distinct form of ethical investing. For example, as mentioned before, investments in alcohol, gambling, pork, tobacco, etc. are prohibited. Countries consuming such products and services would have a problem setting up their businesses to meet the consumer demands. So it might not be completely realistic or even possible to implement Sharia law on a global scale. For example, a lot of banks in even Muslim countries don't follow the Sharia law. So unless the fallback on economic activity is matched with a proportionate increase in Sharia-compliant investments, then it would contribute to recession because it would reduce the overall economic activity. To conclude, in an ideal world, yes, Sharia law could have helped avoid the global recession. However, if we're trying to be realistic, it may not have worked. It wouldn't have been sustainable. Thank you for watching.